Every time prices rise, you lose a little more of your freedom. Groceries, rent, gas. Everything inches upward, month after month. And if it feels like your paycheck doesn't stretch the way it used to, you're not imagining it. You're witnessing the quietest transfer of wealth in human history. One that repeats every generation. Because inflation doesn't just make life more expensive, it decides who owns the future. Welcome to the Financial Historian, where money, power, and history collide, and nothing is ever as simple as it seems. For most people, inflation looks like chaos. Prices spinning out of control, savings fading away, the system crumbling. But for the powerful, inflation is order. It's the heartbeat of the modern economy. It's how governments fund wars without raising taxes, how corporations erase their debts, and how the wealthy watch their fortunes multiply while everyone else struggles to keep up. The real question isn't why inflation happens. It's why it's allowed to happen again and again. To understand that, we have to go back to a time when inflation was treated as a national emergency, not an economic strategy. In the early 20th century, money was tied to gold. Every note represented metal locked away in a vault. Money was scarce and stable. Governments couldn't simply print their way out of mistakes. If you ran a deficit, you raised taxes or you admitted defeat. Inflation meant failure. It meant war, collapse, or chaos. Then came the Great Depression. Prices fell, wages collapsed, banks failed. Money became more valuable by the day, and nobody spent it. Deflation froze the world economy. It was an economic death spiral, and it changed everything. By the end of World War II, inflation had transformed from a danger into a tool. Governments emerged buried in debt, some owing more than double their GDP. They couldn't repay it honestly. So they didn't. They let inflation melt it away. Through the 1950s and 60s, nations quietly reduced their debts not through growth, but through devaluation. $1 trillion of war bonds became half that in real value a decade later. The lesson was clear: moderate inflation could solve impossible problems, without anyone noticing. Then, in 1971, everything changed. President Nixon ended the dollar's convertibility to gold. It was meant to be temporary. It became permanent. Money stopped being a measure of value and became a tool of policy. For the first time in history, the world's dominant currency was backed not by gold, but by belief. You couldn't exchange it for metal anymore, only for more dollars. Inflation was no longer a symptom. It was a design feature. From that moment, the rules changed forever. Money could be created infinitely, as long as people kept believing in it. Governments could borrow endlessly. Banks could expand credit without limit. And investors learned that in an inflationary world, savers lose and borrowers win. Inflation flips the logic of money. If you hold cash, it erodes. If you hold debt, it dissolves. A crushing mortgage today becomes light as air decades later. Meanwhile, assets, homes, stocks, land, all rise in nominal value. Inflation shrinks debt but amplifies wealth. It's not a conspiracy. It's arithmetic. It's the mechanism that keeps a debt-based economy alive. Without inflation, every dollar borrowed would have to be paid back in full value, an impossible task in a world built on credit expansion. So the system quietly agrees, better to let money lose a little value each year than let everything collapse. But for the average person, the cost is devastating. Wages rarely keep up. Prices climb faster than paychecks. Savings, once the foundation of security, become a slow-motion loss. Inflation rewards ownership, not labor. It punishes caution. When your bank gives you 3% interest and inflation is 6%, you're not earning, you're paying for stillness. Meanwhile, those who borrow to buy assets see their values soar. That's not luck. That's the design. Inflation doesn't redistribute money randomly. It redistributes it upward. Those closest to the source of money, banks, corporations, governments, touch it first before it loses value. By the time it reaches everyone else, it's already diluted. This is the Cantillon effect, named after an 18th century economist who saw it centuries ago. New money benefits whoever touches it earliest. Then and now it's the same story. The powerful get it first, the rest pay the price. After 1971, that logic became the foundation of the global economy. What once punished overspending now rewarded it. What once disciplined governments now liberated them. Inflation became the silent glue holding the entire system together. By the 1980s, central banks perfected their balancing act. They promised price stability, 2% inflation, just enough to seem harmless. But over a generation, that harmless 2% cuts the value of $1 in half. To the average worker, groceries double in price. To the rich, assets double in value. Because when inflation is steady, debt is predictable, and the wealthy don't fear inflation. They own it. They own the houses that rise in value, the companies that raise prices, the stocks that inflate with every printed dollar. Inflation is their business partner, their invisible co-conspirator. Governments love it too. It makes national debt smaller in real terms. Deflation exposes weakness, but inflation hides it, quietly transferring the pain downward. And the bankers, they love it most. Inflation guarantees a world that must always borrow. If saving is irrational, everyone must invest, must speculate, must chase yield. And every chase feeds another loan, another product, another derivative. The architecture of modern finance depends on the idea that tomorrow's money is worth less than today's. But the higher you are in the system, the more control you have over that fact. If you live on wages, you fall behind. If you live on assets, you pull ahead. If you live on debt, it either destroys you or makes you rich. That's how inflation turns knowledge itself into capital. The 2008 financial crisis should have been a reckoning. Instead, it became a masterclass in controlled inflation. Central banks printed trillions, not for citizens, but for financial markets. Asset prices soared, wages did not. It wasn't corruption, it was policy. Then in 2020, the cycle repeated under a new name, stimulus. Governments flooded households with cash. Demand exploded while supply chains broke. Prices surged. And once again, those who owned assets thrived, while those who didn't fell behind. Different decades, same story. Inflation doesn't create greed. It amplifies it. It doesn't pick winners. It empowers those already winning. From Weimar Germany to post-war Britain to modern America, the pattern never changes. Inflation is the oldest wealth transfer in history, and the most respectable one. Because beneath every headline, every cost of living crisis, lies the same truth. We built an economy that requires inflation to survive, not as a failure, but as fuel. Even when central banks fight inflation, their real mission isn't to destroy it, it's to control it, to make it feel like stability, while quietly eroding the value beneath your feet. Because if inflation truly disappeared, growth would stop. And so, the war on inflation becomes performance. A balancing act between honesty and illusion. Deep down, those in power know a little inflation is the price of keeping the dream alive. But inflation isn't just economic, it's psychological. It changes how we live. It teaches us to spend now, plan later. It punishes patience, rewards risk, and turns saving into fear. It creates perfect consumers for a debt-driven world, always spending, never satisfied. That's how inflation becomes culture. We call it growth. We call it prosperity. But beneath those words lies a centuries-old machine of devaluation, reinflation, and rediscovery. Inflation isn't chaos, it's control. It's how power measures time. It rewards those who borrow and invest, and punishes those who earn and save. It forgets those who still believe money holds its value. That's why the rich love inflation, and you don't. To them, it's not theft, it's strategy. Every generation learns the same painful truth. Money's value is never fixed. The only question is whether you're the one losing it, or the one deciding what it's worth. Inflation didn't appear out of nowhere. It's the natural consequence of a world that wants everything now and pays for it later. It's the quiet engine of debt, the fuel of empires, the oxygen of capitalism itself. Because inflation isn't the fire, it's the air that keeps the fire burning, and the world we built can't breathe without it. Inflation is often portrayed as an unfortunate side effect of economic growth, but in truth, it is a deliberate and necessary mechanism built into the foundation of modern finance. The global economy, especially after the 20th century, evolved into a system that relies on constant borrowing and credit creation. Every dollar, euro, or yen in circulation today represents a promise to repay debt, and for that promise to remain manageable, money must lose a small portion of its value over time. This quiet erosion allows the system to function without collapsing under the weight of its own obligations. Without inflation, Every loan would have to be repaid with money that retains the same purchasing power it had when borrowed, making it nearly impossible for both individuals and governments to sustain their debts. Inflation solves this problem by reducing the real value of what is owed, turning what should be financial discipline into mathematical convenience. The structure of a debt-based system means that new money is created through lending. When banks issue loans, they generate new currency that enters the economy, expanding the money supply. This expansion fuels demand, growth, and employment, but it also builds an ever-growing mountain of debt that can never be fully repaid unless the value of money itself is allowed to decline. Inflation, therefore, acts as the release valve. It ensures that yesterday's debts can be paid with tomorrow's cheaper currency, allowing the illusion of progress to continue indefinitely. This mechanism keeps consumption high, encourages investment, and sustains government budgets that would otherwise be crushed by interest obligations. Governments have learned that controlled inflation is easier to manage than austerity or default. It is a hidden tax, one that quietly transfers a portion of purchasing power from the public to the state. By allowing prices to rise and money to lose value, the government can effectively reduce its debt burden without openly cutting spending or increasing taxes. The public feels the effect in daily expenses, but few recognize it as a deliberate policy. Inflation allows politicians to promise prosperity while avoiding the painful choices that true economic balance would require. At the same time, central banks play their role as the guardians of this system. They claim to fight inflation while ensuring it never truly disappears. Their target of around 2% annual inflation may sound modest, but over decades it halves the value of savings and doubles the cost of living. This slow and steady devaluation is not a flaw. It is the lifeblood of a credit-driven world. Each year, new money must enter the system to pay the interest on the old, and inflation ensures that cycle can continue. The result is an economy that survives not through stability, but through perpetual motion, a system where value must always slip just enough to keep the gears turning. When the world abandoned the gold standard, money itself was reinvented. For centuries, currency had been tied to a tangible store of value, gold or silver that could be weighed, measured, and redeemed. This system imposed discipline on both governments and individuals, as the amount of money in circulation could only expand as fast as the gold reserves behind it. The gold standard was not perfect, but it created a world where money represented trust grounded in scarcity. Then, in 1971, that connection was severed, when the United States closed the gold window, the dollar, and by extension, all global currencies tied to it, ceased to be backed by anything physical. Overnight, money transformed from something of inherent worth into something sustained purely by confidence and policy. This shift allowed governments to do what was once unthinkable: create money without restraint. The dollar, once exchangeable for gold, could now only be exchanged for more dollars. Its value became a matter of belief, of perception, of faith in the institutions that issued it. Inflation, once a consequence of crisis, became a tool of governance. It was no longer the result of economic mismanagement. It was the mechanism through which economies could be managed. Central banks discovered that by controlling the supply of money, they could influence everything from employment to growth to the political mood of entire nations. The printing press became the most powerful instrument of modern power, invisible, silent, and without democratic oversight. This transformation redefined debt as well. Under the gold standard, debt represented a true obligation, repayment in money that retained its value. In the fiat system, however, debt became fluid, flexible, and almost abstract. Since money could be created at will, governments could borrow endlessly, confident that inflation would gradually erode what they owed. Corporations learned the same lesson, using leverage to expand faster than ever before, knowing that tomorrow's dollars would be cheaper than today's. Banks, once intermediaries of savings, evolved into creators of credit, manufacturing money through loans rather than deposits. Every financial instrument, from bonds to mortgages, became a bet on the future stability of this man-made confidence. The abandonment of the gold standard also reshaped global trade. With floating exchange rates, currencies no longer needed to hold a fixed relationship to one another. This gave countries the ability to manipulate the value of their money to suit their own interests. Devaluation became a weapon, and inflation became a tool of competition. The result was a financial order where stability was maintained not by the weight of gold, but by coordinated belief. The dollar's dominance continued because the world collectively agreed to trust it. Money stopped being a measure of value and became a symbol of policy, an instrument through which governments could rewrite economic reality, print growth out of thin air, and conceal the true cost of their decisions beneath a constant, controlled erosion of purchasing power.